Okay, hello and welcome back. I'm your instructor, Daniel Kirsch. So today we're going to talk about economic and social policy directed by the U.S. government. And so one thing that I want to do is kind of put into some context what it is the federal government does and what their relationship is to the American public. So for one thing, let's talk about the federal budget and why they spend money on what they do and what are some of the differences between what the federal government does and what some other agencies do. So the first thing is that there are two types of economic policy you should know about. So let's see. First, fiscal policy. Fiscal policy is simple. It's just the amount of money the government collects and spends every year. So when we talk about fiscal policy, we're talking about the IRS. They collect the taxes we're talking about. And we're talking about the annual budget process in Congress. And we're talking about the cabinet, the Department of the Interior, the Department of Transportation, building new roads and bridges, spending money to do that, just the government spending. Money it's the check that comes from the Treasury. All of this is fiscal policy. The government is going to write a check to anyone, and whether they're going to spend millions or trillions of dollars every year on one policy or another, together the federal government is spending money on all of those priorities. About $5 trillion annually is what they spend. Okay, so that's the federal government's fiscal output. And a lot of that comes from income taxes. The vast majority actually comes from income taxes. Historically, it did come from tariffs, or what are called taxes on imports. It didn't really change until about 1913, when the income tax was the 16th Amendment that made it so that the income tax could be passed, could be allocated to people individually, and not just apportioned between the several states, which is what the first draft of the Constitution said. So that's a big constitutional amendment they had to pass, and it allowed them to lower and raise taxes on imports in a way that didn't impact whether or not they were going to be able to pay federal government's employees or not. So this changed. It allowed them to have a more stable income for the federal government, and they didn't have to worry about getting a lot of tax revenue from their, say, imports from France or any other nation. But also something happened in 1913 that was the beginning of a really organized U.S. monetary policy, money policy. And that was which is really run entirely by the Federal Reserve System. There had been a central banking system before in the U.S. a couple of times, and that they had always expired. There was, I believe, 3 or 4 attempts at a permanent national banking system, and this was the latest one, and it's lasted since then. But if you do happen to have a dollar, you can take a look at the bottom of it, a simple dollar bill. It says Federal Reserve Note. And what that means is that it's within the federal reserves we have, which is really our central banking system. It's printed by the U.S. government, and it's redeemable by just being part of the system. But it used to be in the 18th and 19th centuries that it was usually redeemable by something metallic like gold or silver. They used to be called, I know my parents and grandparents used to show me dollar bills that had the word silver certificate on it. And you don't see that anymore. You just see Federal Reserve Note. That's what Fort Knox used to do. He used to hold all the U.S. gold bullion reserves. Now is no longer, I believe, even though the U.S. government does have gold reserves, I believe, it's not really all just at Fort Knox. In the 1890s, farmers and low-wage workers wanted the federal government's money to be based on silver because silver is more plentiful, and there's more money, and so the money would be worth less, and it would be borrowed at an easier rate, and so there's a looser money supply. That just meant that in today's terms, credit would be easier to obtain for working class folks, so that they could buy a house or refinance their farm if they wanted to stay on it in a bad year. I want to give kind of a more political take rather than economic on the history of what we're talking about here. To that end, let me offer a non-economic characterization of where we stand in the modern era. A lot of the value that is held today by U.S. money, or all of it really at this point, is based on not on metal, but on confidence. This changed really in the early 20th century. And during that time period, it was thought that this was ridiculous, that we have the most powerful economy in the world at that point, and still do, and theoretically you would still have to be able to exchange a paper dollar for some kind of metal. So why don't we just base it on the confidence in our economy, since we have a lot of that? So they did that, and through the decades, a lot of decades of debate, of course, the Federal Reserve System now just guarantees, and the federal government also guarantees, every Federal Reserve note, every dollar bill, every $5 bill, every $100 bill, all of them. So the Federal Reserve System is governed by the Board of Governors, and that's not to get into this totally, but essentially the head of the Federal Reserve Committee, of their open market committee, is appointed by the U.S. president. And even though that person is appointed by the president, they are considered an independent actor in law. And they are not accountable to the president. There's no impeachment process. They're not, strictly speaking, a federal employee. Federal Reserve is essentially funded by banks. They are run largely for banks. What they are is the lender of last resort to large banks, and their function is basically governing the entire economy in a way that is beneficial to the entire economy. So the chair of the Federal Reserve has one especially prominent and important tool to do this. And this tool is the interest rate. Okay, so economic policy, monetary supply is controlled by the interest rate. Let's see. They determine the interest rate they determine on the money they lend to large banks, large commercial and investment banks in the U.S., determines the amount of money in circulation, because it gives an incentive to borrow money, or it gives an incentive to slow down on borrowing money by those commercial and investment banks. And if those commercial and investment banks have an incentive to borrow money where it's cheap and the interest rate is low, that means that they will. They will in turn lower their own interest rates to smaller banks, and those smaller banks will have an incentive to loan more money to others to lower their interest. So consumers and smaller businesses will want to see it as an opportunity financially to borrow money from that small bank. So if they raise the interest rate, that means that there is a slowing effect on the money supply. But if they lower it, that means there's more money in circulation. And it's really the Federal Reserve System's job to not only make sure there's enough money here in circulation, or not enough money in circulation to make sure that inflation doesn't get out of hand. So inflation is this idea that if you simply print money, eventually the money will become worthless. Because there's so much of it that's the kind of slippery slope that inflation is all about. But you don't want inflation if you're trying to work towards a pension, or you're saving a lot of money, you're a good saver. But if you're, say, a borrower with a long-term fixed loan, and you may want inflation because it might be easier for you to repay a loan if your wages are rising with inflation and you have more time to pay it off. Like, let's say you have a 15 or 30-year mortgage, and it's the same amount that you pay every month and every year, but your compensation is going up every year with inflation. So you end up basically paying less over the time period of that loan than if you had paid it, up front. Let's see, and your wage keeps going up, yeah. So that's the reason why potentially is good for consumers, but it's really bad for banks and wealthier people over the lenders or ones kind of lending money in the first place, because they get a lower return on their eventual investment. So when the interest rate gets to be close to zero, that means the lenders really just want to save the economy. They really just want to save the economy for their own benefit, of course, but they want to be able to stabilize consumer spending so they can continue to operate and make profits. So it's sort of an existential crisis when you're down to zero interest rate. So during the financial crisis from 2008, 09, and 10, and I don't think it was until the 4 or 5 year mark after that initial crash where they started to raise the interest rate above zero. The Fed decided to raise the interest rate a little bit higher than zero to kind of slow the economy down. But basically, consumer workers usually like the interest rate to be as low as possible. You've heard of 0% loans for car loans, right? Probably not for mortgages. But if you have an interest rate that's so low, they don't have to, eventually the Fed has to pay banks essentially to borrow money. If they get lower than zero, they're essentially, giving away money so that there will be more money in the monetary supply to make lower interest rates, to incentivize more people to borrow and more people to spend. So that's kind of what the Fed does. And former President Trump liked to criticize the Fed, even his own appointed Federal Reserve Chair, Jerome Powell, because when they decide to slow down and to do what's called pump the brakes on the economy, he or any president doesn't like the economy to slow down. He likes for it to go faster, and because that means more people are doing well and more people think that the president is doing a good job as a result. They want the next president to have to worry about a recession and layoffs, and it's a delicate balancing act, because on the one hand, you have essentially the popular will and the president. On the other, you have wealthy folks who want to be able to have an incentive themselves to invest in the economy. And to keep money in circulation, to make it a really active economy is on the one hand. And those property owners I discussed, they want inflation under control. So those are sometimes they usually clash in public policy. But it's hard to reconcile the two, and that's what the Fed ends up doing. It's regulating the economy by governing how much of the money will be in circulation during that quarter, during that 3-month period where they made the interest rate raise or lower recommendation. So now that's the hardest part out of the way first, I think. Now let's talk more about fiscal policy. A little bit more about budget making and about the welfare state in the U.S., such as it is. One of the things you should really know is that all of the welfare state at least started to be created in the 1930s out of some of the New Deal programs that formed the foundation of the American welfare state. And I say American welfare state in comparison to what's usually called the European welfare state. It's supposed to be a social safety net. But in the U.S., it's very much often referred to by historians and analysts as a patchwork of different programs that doesn't provide much of a safety net. But it really is very paltry, as I said, in comparison to other countries' and welfare states. But it's what we know today, and so the OASDI, Social Security as we know it, was called Old Age Insurance, and today it's called Old Age Survivors and Disability Insurance, and it was run by an agency called the Social Security Administration, as it still is. So the program is called Social Security, but its official first name was OAI, Old Age Insurance. And now it's the same program, and so there's another, but we'll come back to how that works. There's also unemployment insurance, or UI. Say there is little awareness about how we got to all of these things during the New Deal, but unemployment insurance is a huge indicator, and new applicants for it are a huge indicator of how well the economy is doing. A lot of economists have said that the way we used to calculate unemployment insurance, you can read an article in Forbes that I think I've linked on Canvas, that if we calculate our unemployment insurance in those numbers the same way we did in the 30s before that insurance program existed, what we're seeing right now is actually depression-level unemployment. It's about 25% at least under in unemployment. A lot of people are underemployed, so they're not counted as part of that, and a lot of people have stopped trying in the workforce, and so they're counted either under disability numbers or they're just not counted in the unemployment insurance numbers. So there are workers that are qualified enough through no fault of their own. They have one job or another that's part-time. They used to be full-time before all the layoffs occurred. So that's unemployment insurance. And there's another one called, that used to be called ADC and then AFDC, Aid to Families with Dependent Children. And today that's been replaced. That was what we used to call welfare. That ended in 1996. And today there's another program called Temporary Aid to Needy Families. And that has a time limit of 2 years at a time. And it also is a fraction of the benefits that ADC used to have. And it's run by the states also. Often there are very stringent requirements that include having to go to work. So essentially you're going to work for less than minimum wage for a lot of these benefits. It's administered through a block grant, by the way, to states. Let's see. Yeah, during the Clinton administration, as I said. So those are kind of the three bedrocks of federal social policy. One of the things I want to tell you about in terms of Social Security is the way that it does work. It's a system that's called payroll taxes. They always have been operated by that. The idea is that payroll taxes, that is those taxes that are literally just the paycheck that you receive for your wages on either a weekly or bi-weekly or monthly basis. The revenue from workers' paychecks are able to pay the obligations that the program, Social Security, has to all the current retirees, drawing money from Social Security, the so-called trust fund. In reality, it's a little bit of an accounting and political fiction because it's not as if you pay money into like a giant savings account in Social Security and you get all that money back if you worked for it. If it worked that way, hardly anyone would get paid by Social Security, and would also, even if you did get paid, inflation would be such an enemy to you that you probably would have a lot less than you thought you did and burn through most of your savings in the first couple of years. But instead, Social Security, the way it works is during your whole life, you incur a certain amount of investment and credit in the fund, and then based on a certain formula, you get a certain amount of money back, and they adjust with a cost of living increase every year, what will eventually come out to you. So that year's equivalent for next year's benefits. So for example, I just happen to have access to one average worker's Social Security statement, and that is someone who has been paying Social Security for about 25 years, and it gives you a statement of how much you were taxed every year. So if you go to, if you wanted to do this, you could go to ssa.gov or myssa.gov if you're a U.S. citizen, as long as you have had, or if you've had at least one job, you have a Social Security number and you can have access to it. So with every paycheck you earn, you pay 6.25% of that paycheck into Social Security. Now that's a big amount, and it's a percent for your whole life. That's the way it works. They actually collect more than that. They collect twice as much as that, because let's say you worked at a job and they pay you like $100 a week. Somehow you were able to get $10 an hour as a part-time job, and you get 10 hours a week. So out of that $100, you paid $6.25. Then your employer has to match whatever that 6.25% comes out to. So for our purposes, they have to match $6.25. So that doesn't come out of your paycheck; it comes out of their funds. So you still end up with $93.75. But they still have to pay an additional $6.25 to the fund. So every $100 is taxed in terms of a paycheck from an employer to a wage worker. And the idea is that, again, it's the taxes are enough of revenue to be able to pay it, just because that's the way it's set up right now. You actually, they say that right now Social Security is in trouble. Maybe if you look at it a certain way, but here's how it's not. So Congress has to be able to make sure that it's solvent. There's two things that Congress can do besides just raising taxes and cutting benefits. All they have to do, let's say you can keep it at $12.50. All that Congress has to do is to raise the cap on Social Security earnings. So remember that 6.25% I talked about? Well, if you happen to make more than $137,000 a year, every dollar that you make beyond that is tax-free in Social Security terms anyway. And it's only, they add an additional 0.9%, so an additional 10 cents of every, more like a dollar of every paycheck after $250,000. So it's not much of an increase. And so, and they index the 137,000 for inflation. But if they really wanted to bring in more revenue, they could actually raise the cap from 137 to say 150 in a year or 200. It would bring in a lot more revenue. Let's see, they can. So that's not a popular thing to do, but it does function like a regressive tax. They could also cut benefits, which they have in creative ways over the years. Let's see. And if they needed to in the meantime, they could always pay Social Security out of the general fund. And again, that's not a long-term solution, but year to year, it's not as if it's going to go bankrupt in a certain year. And so there's already a deficit, so what's a few more dollars? But really, it's a matter of Social Security has never been bankrupt, and it's always had to have adjustments made for accounting in the future. But they really have they're solvent really until about 20 years from now, and so between now and then, as long as some adjustments are made, they can be solvent for the next 100 years. So the U.S. is actually, in terms of the general fund, the U.S. has actually spent more money that's collected almost every year. And how do they borrow more money? They just borrow more money from banks. They can be U.S. banks, they can be Chinese banks or Japanese banks, they can be European banks, any banks around the world they can borrow money from. And that's when those banks, they buy treasury bills, like they buy a savings bond, basically. That's what debt is. They're buying a guarantee that the U.S. government will pay them back when that savings bond is due. Treasury notes is what they're also called. They do all of that just because there is a deficit. Just about every year there's a deficit. This year there's a massive deficit because of the coronavirus. The U.S. government typically in recent history has spent about $5 trillion a year. But the first coronavirus relief package was about $1 trillion. And the second one looks like it's going to be about $2 trillion. So the U.S. government is going to spend about $8 trillion in a year. It expected to spend $5. It only has about $4 trillion to spend. So it's going to have to borrow about $4 trillion from banks in this year just to make all these payments out to all of the programs that have been addressed by law, and also all of the make all the payments to all of the creditors that the U.S. has. And the national debt, by the way, is about $20 trillion, and so to add $2 or $3 or $4 trillion to that in a given year is quite the exponential growth in the overall national debt, especially when the U.S. kind of gross output economically is also about $20 trillion. So things are getting very, I won't characterize it, but all of that those numbers are very close. So, like as I said earlier, So that's the general fund. That's what a deficit is. But as I said earlier, I have access to one worker that's been paying into Social Security Trust Fund for about 25 years, making today somewhere around $50,000 a year. If that person continues to make that amount of money until they retire, you have three options. You could retire at age 62, and that income would be about $1,300 a month if you had no other savings. But at age 70, you receive about $3,000 a month. So that's why a lot of people elect to retire later, because they want the full Social Security benefit, which could be almost double or more than double. 65 and 67 are also choices you could make, but sort of basically the longer you wait until age 70, the more of an incentive you have to have that annual kind of basically income. So this person would be 39 or 40. In about 20 years you could retire. It'd be about half of what it would be if you waited another 8 years to retire at age 70. So the gamble, of course, is the significant amount of people who will die between the ages of 60 and 70, and 62 and 70 certainly. So a lot of people just have to make that decision. So if they give you a statement, but you also know that there's this person who's been paying about 25 years who makes $50,000 were to become disabled, then they would also get about what they would get at age 62, $1,400 a month. So not what you're making now, right? It's compared to $50,000 a year. You supposedly get all kinds of discounts on things if you're retired, but if you're disabled, $1,400 a month comes out to, what does that come out to? Something like $18,000 a year, something like that. So hopefully you get a lot of discounts. So that's kind of what you'll be making a month, and disability, that's what you'd be making every year. But then your spouse would get the full benefit starting at full retirement age, and also your survivor's benefits would kick in if you were to all of a sudden die. So it's comprehensive, but it's not a substantial amount of money. Let's see. It's the most popular social program the U.S. has ever engaged in. It has supporters in the millions in terms of several organizations, most notable of which is the AARP. It used to be called the American Association of Retired Persons. Today they're known just as AARP because they encourage you to join when you're about 30. They give you a magazine subscription card and they say, please join. They give you all kinds of other insurance benefits, things like that. But the AARP has all these members, and their overarching goal is to protect Social Security. There's another couple of organizations that do the same thing and have disagreements with the AARP, but this system is essentially your safety net if you become disabled early, or if you're a worker, if you become disabled early, you're retired at normal age. Not because you set money aside, but because you've sort of earned this credit and you've worked, now the government has an obligation to fulfill to you. So that's how it works. One thing you should know is that several presidents have tried to make significant changes and compromises for this program. One thing that happened, I should note, is that, as I said, Reagan, during his administration, came up with a compromise where they reduced benefits, and they also raised the contribution from people to something lower, to $625 a worker. So that was one reform that happened. During the Clinton administration, Bill Clinton as president and Newt Gingrich as Speaker of the House, in the late 90s, they had come to an agreement in private. They were going to privatize Social Security, and we know that for certain. Rather than just in the general fund to pay to current workers, they were going to create really aggressive individual retirement accounts, or IRAs. There is a significant amount of risk involved in IRAs, and so that idea would be that they would increase the amount of money, but not everybody would get access to that money. And we'll never know what would have happened because the Bill Clinton administration was kind of frozen after his scandal and his impeachment, but he wasn't removed. He just couldn't really do anything after that politically. And George W. Bush had a similar problem. He wanted to privatize Social Security during the second half of his administration, but he was then waylaid by Hurricane Katrina, and the scandal of the mishandling of that by his administration. So let's see. I'm just scanning my lecture to see if all of this is relevant to you. Sorry to break the fourth wall here, but I think that's essentially all you need to know about Social Security. And but now let's talk about Medicare and Medicaid. And Medicare basically works almost entirely the same way. It was a social program that started really during the Johnson administration. It was talked about a lot in the post-World War II era. For the U.S., really kind of decided in the labor market that large employers, through especially ones like car companies negotiating with their labor unions like the United Auto Workers, who essentially said, we're going to guarantee health care to the workers at our plants because that's what we're going to negotiate in terms of our contracts, and to retain good workers. We're going to provide them generous benefit packages. We're going to give them health care and benefits, pensions, so that when the largest employment deals were struck, lawyers were kind of saying that the U.S. had the economic engine to do all of that. So all the employers started to do what the auto workers had. It wasn't too long before the 1950s, just about every job you get in the U.S. had not only full health care benefit, but there were also there weren't a lot of part-time jobs. You could just get a full health care package for a part-time job too. A pension, meaning something like Social Security once you retired, this really went away in a big way over the last 30 years or so. Only about 7% of employers have some kind of package that's available to employees that's a non-Social Security guaranteed benefit pension. So now it's all individual savings accounts, 401ks that you can invest. But then if you lose it all on the stock market, then you're out of luck. So it's not really a safety net so much as a savings program for individuals. So let's see. So Medicare is very similar to Social Security. It's funded much the same way. You have to pay through payroll taxes, but a much lower rate. And Medicare is pretty good. It's really good. It's, again, a very popular social program, partly because it's universal, meaning that everyone is entitled to it when they start taking Social Security. 62, I believe, is the earliest you can opt in, unless you are disabled. You can opt in earlier. They've been paying into it, so according to kind of the American social contract, they're entitled. That's where the word entitlement comes from. Legally, they're entitled to a certain benefit when they retire. So it doesn't cover everything, and there are several different programs within Medicare I don't pretend to understand at this point. But I guess it's a number of years before I have to figure it out for myself. But you can purchase other insurance to supplement your Medicare, and most people do to a certain degree. Medicaid is different. Medicaid is the program for the poor, and in California it's called Medi-Cal. When I moved here in 2016, this may have changed, but 40% of Californians, especially in some of the counties in the Central Valley, are on Medi-Cal. It's administered by the states, but that's what it's called here. So let's see. In this area, there's something called sorry for the dead air, but I'm just looking for what you need to know, and I realize that this is not what you need to know. So what you should know about modern healthcare is that healthcare and Obamacare is not a radical change from what existed earlier. It was, this idea that 44 million Americans were not insured, and Obamacare was a bill to try to alleviate that. But it's a combination of three things. Obamacare is supposed to be mandating that people buy health care, providing a subsidy if they don't have it, and allowing people to be covered despite their pre-existing conditions, and finally for people to be allowed to stay on their parents' insurance until they're 26. So it was this idea that you were going to be making insurance carriers cover people who they didn't want to cover, but the incentive was you were going to provide to them millions of new customers, and you were going to expand the insurance pool, and that would eventually bring costs down. I actually lived in Massachusetts when they tried this under Governor Mitt Romney in 2006, and I have to say it works better than it works nationally, because nationally they were given additional money for implementing this program through Medicaid. But I think the majority of states were run by opponents of President Obama, Republicans, and they opted not to take the additional Medicaid money. So I would say this unfortunate political football between Republicans and Democrats, because all it really did was injure the confidence the American people had in any sort of healthcare system, because the Obamacare system fundamentally changed really nothing. I tried to just mandate the existing system and kind of patch that system. So now here we are 10 years later with a system that looks a lot like the system it started out with. And they've had, they did have a couple of meaningful reforms. They wouldn't, but that's pretty much it. Let's see. And it just makes it more expensive for everyone else because they have less money in the insurance pool to pay out. That was it was a really complicated law, but it took 18 months to pass, and they barely passed it, even though they had a massive Democratic majority in 2009 and 2010. But it still was so unpopular that Republicans were able to take advantage of its unpopularity and take back the House and Senate in 2010. So let's see. So all these other countries that have healthcare systems, the U.S. system is not at all comparable to most other kind of industrialized democracies. But this was one more step towards it. But really, at this point, it's become so fragmented again that it's probably the reason for the popularity of ideas like Medicare for All among both Republicans and Democrats. So the last thing I wanted to talk to you about is tax policy and budgets. And so what I'm going to write down right now is that the top percentage of tax policy back in World War II was something like 94%. And for years, for decades, it was lowered to 70% until the 1980s, until Reagan and Bush raised it to 28 to 30%, or I'm sorry, lowered the top rate to 28 or 30%. It eliminates, so this was a progression of how high taxes were to how low they've become for the wealthiest individuals. Now, they didn't pay this whole 94% necessarily, but it was sort of a starting point, and it was this acknowledgement that that those who had a lot of wealth were really were expected to pay a lot more towards the American social welfare state because they were getting so much out of these workers. But now today, it's become a lot more couched in notions of somehow fairness and justice, that everyone pays a very similar rate. And so the idea of progressive taxation of, the more you have, the bigger chunk of your wealth you're supposed to pay, has not really maintained in terms of the political conversation. So I don't want to go kind of back and forth too much during this to explain how much there was a progression between different presidents from one tax rate to another. You can follow it all in your textbook if you want. But I will say that, the latest round of it was President Trump's tax cut bill in 2017 that did continue the trend that was started by Reagan of lowering taxes for the wealthiest. But even though it was called the Tax Cuts and Jobs Act, it's surprising that probably if not a majority of people, then certainly a very high number of people who kind of make less than $100,000 a year, the vast majority of people, a big chunk of that demographic, ended up paying more in taxes because a lot of deductions were eliminated, including things like the state and local tax deduction. The marriage deduction was somehow increased, but then the charitable contributions thing was also really weakened. That deduction was weakened. So the Tax Cuts and Jobs Act ended up being one of the things that was one of the less popular, or at least more neutral than ever before, tax cut policies that a Republican has ever passed. Because President Bush and Reagan, President George W. Bush, I should say, and Reagan had passed very popular, massive tax cuts, and Trump was looking to do the same. But it looks like he kind of hit the ceiling of how much there was more call maybe for more social welfare spending than that. So I will say that every year you have a new tax cut without new spending cuts, you're just increasing the national debt, meaning the amount you have to borrow to pay your obligations. And even though the Reagan administration and the George W. Bush administration were successful at cutting taxes, they were not as successful in cutting spending. They tried, but they couldn't get it past Congress. So you end up with there was a $5 trillion national debt. There was a $1 trillion national debt when Reagan started, and he ended up with a $5 trillion national debt. And there was not that much inflation, so that was real money by the time 1990 hit. I may be $1 trillion or two off, but I think it was might have been $4 trillion when he left office. So he at least tripled or quadrupled it while he was in office. So the U.S. social and economic policy, what I want to leave you with is that the policy itself as a whole is only as good as how well it's serving the people. And it hasn't really, it's done a decent job, but it's not really keeping pace with the global economy. And it's certainly, there's a lot of complicating factors here that I'm not really going to get to. Education, transportation, immigration are all domestic policies. But one more thing I want to take you through is the policy process. And that's simply a framework for understanding how policies are created. And policies are just a $10 word for law, or anything the government does. And agenda setting is at the beginning of that. That's just what issues are we going to talk about? And usually that's Congress and the president. Formulation is when they start to come up with ideas for bills to what to do. Decision making is deciding which of them we're actually going to vote on, and then voting in the affirmative and creating a new law. Implementation is when the executive branch administers a new law, when they go out and, for example, like I said, the tax cut, they ended up implementing a law, and they ended up surprising a lot of people that they were paying more taxes. An evaluation is, how much do we think that policy worked? And everyone gets to evaluate it in a democracy. All voters, all members of Congress, presidents themselves, policy experts, everybody evaluates. And then that goes back into, eventually, is it going to still be part of the agenda? And are we going to go back through the process again? So that's all I have for today on economic and social and domestic policy. I know I haven't touched on all of it, but I hope I give you a better idea of the difference between what some of these things are and how much is really required to maintain a lot of them through the policies and debate that we have about all these issues. Okay, thanks for watching.